Good morning, everybody. Welcome to the 13th Emerging Growth Conference. I'm Anna Berry, and I'll be your host today. So just a few notes for those of you attending. This is a live continuous event. It's beginning now and running until 1 p.m. Eastern Time. So when we switch to the next company, you're going to see a black screen for a brief moment, but don't go anywhere. It's just us moving over. And if you do experience downtime for more than a minute or two, just refresh your browser and everything should work again. Now, our platform does work best on Google Chrome. So if you're watching from an Apple device, you have to hit the play button to start the session. As always, we have an exciting list of companies and a wide range of growth sectors presenting to you today. And our previous conferences and all of our conferences to come will be uploaded to the Emerging Growth Conference YouTube channel. So be sure to subscribe at youtube.com/Emerging Growth Conference. During each company's presentation, you can submit questions through the webinar module, and the presenters may attempt to address as many of these as possible at the end of the presentation. And one last note, after today's event at 1 p.m. Eastern Time, you'll be redirected to the registration page for the next conference. So be sure to stay on or come back to reserve your spot early. Now, today we have 6 companies presenting. So without further ado, I would like to introduce our first. Please welcome Bannerman Energy Ltd. It trades on the OTCQB under the symbol BNNLF and on the ASX under the symbol BMN, and is an Australian and Namibian listed uranium development company. Its flagship asset is the advanced Etango Uranium Project, which is located in the Erongo Region of Namibia. Please welcome its CEO, Brandon Munro. Welcome, Brandon.
Thanks so much, Anna. It's a pleasure to be here.
Well, we look forward to your presentation. Brandon, the floor is yours.
Great. So, hi, everyone. It's great to be here talking about our Etango project, and particularly since just on Monday, we put out a pre-feasibility study on our Etango 8 streamline development of that very large ore body. So Bannerman, yes, we are a uranium company, but we feel like we stand for so much more. We're part of the nuclear industry, and our vision is social leadership in the supply of raw materials for emissions-free power. And that's exactly what we want to do with our uranium produced in Namibia. In your leisure, you can read through these disclaimers. And first, I'd like to introduce Bannerman, and then I'd like to spend a few moments really taking you through the uranium sector. It's something that's close to my heart and something that I'm quite immersed in. So as Anna said, Bannerman is listed on OTCQB under BNNLF and on the Australian Stock Exchange as well under BMN. We've got a market capitalisation today of about 190 million Australian dollars. That's 140 million US dollars. Very robust balance sheet. We've got 12.5 million Australian, or just a bit above 9 million US in the bank with no debt and a low cash burn. We've got a very strong board there that we can go into later. As you can see from that share price graph, we have enjoyed the momentum that all of our peers in the uranium sector have. And I'm pleased to say that we've really performed well over the period since the beginning of December, when this sector started to attract investor attention. That's our Etango project in Namibia. Namibia in southwest Africa, very stable country, and I'll tell you a few things about that later. It is a very large project. In fact, it's a globally large scale resource endowment that we have at Etango. We can boast very low conventional technical risk. It's a truck and shovel mining operation with heap leach. The infrastructure it's excellent, particularly for Africa, but even in its own right, you can see from that map that we have everything that we need close to our project and close to population centres. Namibia itself is a premier uranium development jurisdiction. We've been exporting uranium for more than 45 years from Namibia, from more recently 3 different mines out of the deepwater port of Walfish Bay. We've got, in particular, very strong in-country relationships. We have an in-country management team, so we've been really totally avoided any adverse effects from COVID because of that. But in fact, I spent more than 5 years living in Namibia, working in the uranium sector and the resources sector. So we do know the country very well. And with the development of our Etango 8 uranium project, we've now got an alternative pathway to development. So in addition to the world-class scale of the asset, we now boast scalability. So when you look at all of those attributes, I'd hope that you'd accept that we believe that we have in Etango a world-class uranium asset. I'd like to spend a couple of minutes just talking to you about the Etango journey. We started in country in 2005, and throughout that 15-year period, we have been focused on uranium, on Namibia, and on the Etango asset. We initially raised good money in the last boom, I'm pleased to say, and used that low cost of capital funds to do the heavy lifting. 300 kilometres of resource drilling, for example, which is what it takes to drill out the resource of such a large asset. Now, we all know that this sector's been in a bear market since about 2011, and we've had to be very, very careful with how we spend our funds, but nonetheless, we've continued to move the asset forward throughout that process, culminating in a definitive feasibility study revised in 2015 and all of our environmental permitting. And that was moving towards the pathway of the very large-scale giant Etango project at a 20 million tonne per annum throughput, which would generate an average annual production of 7.2 million pounds. As I say, that is very, very large in our sector and would rate this mine in the top 10 largest uranium mines in the world once in production. Now, what I've been doing with the team in the last couple of years is undertaking an analysis of scale. We wanted to test if this ore body could be developed viably at a smaller throughput and with lower hurdles to development, in particular lower capital costs. As you can imagine, such a large project does come with a significant capital bill. And when we've existed through a very difficult bear market, we didn't have the market capitalisation to support that capital ticket. So we undertook this scaling study, and a year ago exactly, we published a scoping study into what we called Etango 8. It's a smaller, reimagined development pathway where we can get into production sooner at a much lower capital cost with fewer development hurdles. And as I'll tell you, once we're in production, we've got the option, once profitable, of then expanding our production, if necessary, up to that 20 million tonne throughput and the 7.2 million pounds you can see there. So what we've just done this week is we've published a PFS that we're very pleased about. The reason I wanted to share this journey with you is not only for you to understand just how immersed in Namibia and uranium and this project we've been and how much technical investment we've seen, but also we've got two very distinct pathways, two alternatives that we will choose between when we're ready to finance this project based on market economics at the time. And what that does is it enhances the sheer leverage that we get from the size of our resource and gives us two alternative pathways to maximise shareholder value into the next uranium cycle. Now, a few moments to talk about the Etango PFS that we released just on Monday. So first of all, the key outcomes. We will undertake a throughput of 8 million tonnes per annum, hence the name Etango 8. That will generate 3.5 million pounds of average production. So although it's half the size of the original giant project, make no mistake, this is still a very large project in the scheme of uranium mining around the world. Now that's over currently an initial 15-year mine life to generate 53 million pounds of total production. We've got a very good processing yield of 87% and a low strip ratio of 2.1. So what that equates to is a total cost, including state royalties and government royalties, that is under $40 a pound. The pre-production capital is 274 million. That's very competitive for such a large project. And with a $65 uranium price assumption, it means that we're generating a post-tax NPV of 222 million US. We can pay that back in under 4 years, and that gives us a post-tax internal rate of return north of 20%. I talked about the world-class scale and the sheer leverage that we get from the size of the ore body, but I'd just like to put that in context for you. The size of the Etango resource is more than 200 million pounds contained U3O8. Now, that's just the Etango project. On top of that, there are satellite deposits within trucking distance, and also the deposit is open at depth. So we would expect over time this deposit to behave in much the same fashion as the Rossing uranium mine, the giant Rio Tinto mine that's now owned by CNNC. When that started, and when it was constructed by Rio in the 70s, it had initially a 16-year mine life. It's now into its 45th year because of the depth of the material, which we expect to also be present in our ore body. Within that very large resource, we then have the ore reserve for the Etango 8 project. And as you can see, that's a very healthy 60 million pounds of ore reserve with the potential to expand. So what I mean by that is one of the key upsides that we've got in this project is not only the potential to expand the mine life from the initial 15 years, a little bit like our compatriots down the road at Rossing, but also the very real option of expanding our production once we're a few years in. In other words, once we've got into production at 8 million pounds and profitable, we can look at what the market's calling for and be able to add additional processing capacity and additional mining to increase the throughput and the annual production scale. Now, one thing I'd really like to share with you is, although we've made this project smaller from what the original contemplation is, we haven't achieved that by high grading the ore body. We haven't in any way sterilised certain parts of the ore body. Nothing that we're doing with the Etango 8 precludes going further in terms of life or further in terms of scale of production. And I'll show you what I mean with that. What you can see on this slide, that is the final pit design for a Etango 8. So once we've mined out 53 million pounds, that's what the pit will look like. Compare that to the 2015 DFS into the giant-sized Etango, and you can see that it's simply an initial subset of the pit design partway through and the ultimate final pit design that you would see after the giant-sized ore reserve of 130 million pounds would be consumed. So the optionality here to expand and to increase production is very, very real. The pathway to development, I've just put a timeline there. The key point to understand is that we believe that we can continue progressing Etango 8 so that we're in a position to be in production by 2025. And when I come to talk about the market, you realise that that's a very important period of time, because that's when we expect the uranium sector to be coming under some significant pressure due to opening and widening production deficits. Now, we've done a heap of work with this PFS, and we were very proud and very pleased with ourselves when we released it on Monday. And what we've put there is just all of the slides from the presentation, which I think is the most accessible way to understand this technical document and what we've achieved. And I've included the link there so that you can go there and read it in more detail. Now, if you're really keen, or you've got a technical bent, or you just really enjoy reading long technical reports, our announcement is fulsome. We're very keen on comprehensive and credible technical disclosure, so you can knock yourself out with all 113 pages of that, which we've put up on the website too. So I'd encourage you to have a closer look at what we've done with this Etango 8 PFS. I'd like to spend a few slides talking to you about license to operate. This is important in our sector. Of course, it's important in all mining, and ESG, which is the new catchphrase, is extensively used perhaps overused in the context of mining. But in the uranium sector, we've lived and breathed social license, ESG, corporate social responsibility, really throughout our 15-year life. And we took it for granted that this is what you had to do, because in uranium, you've got the constant threat of interest groups and NGOs and other actors who would relish the opportunity to put the company under pressure. So for us, it's been a core value and a core risk mitigant. And I'm pleased to say that these days, those threats have really dissipated because, number one, we're in Namibia and there's enormous social support and community support who effectively run the NGOs out of town when they try and interfere. But more importantly, the social barometer when it comes to nuclear power has fundamentally changed. And the types of NGOs that used to get oxygen and funding through criticising and making trouble for uranium mines and nuclear power, they find it a lot harder these days. Thankfully, we've now got a thematic, which is green finance and ESG, that we can deliver all of our good work into. So first of all, talking a bit more about Namibia. So I said that we've got a 45-year production history of uranium, and that's extremely important. We continue to be a top 4 global uranium producer. In fact, last year we were top 3 in the world after Kazakhstan and Australia. It's politically stable. As I say, I lived there for more than 5 years and didn't even so much as have a car broken into in all of that time. And it was the last African country to achieve independence. So it's actually a very beautiful country. It's a very chilled country. And Lonely Planet Guide calls it Africa for beginners. Such is the ease of life there. So anyone who's got deep, dark Africa in their mind or is concerned about operating risk, those factors just don't exist in Namibia. It is a fantastic place to live, to travel, and also to do business. Now, the other thing to understand is it's got a very strong rule of law. There's a strong mining code that was based on the basically the Canadian and the Australian system. It's transparent, and the country has a strong development agenda, particularly now that COVID has really had a big financial effect on the country's fiscus. In terms of our social license to operate, first of all, our environmental credentials are very strong. We've got an environmental baseline that goes all the way back to 2008. And as I said before, we do have our environmental permits in place. In terms of our social leadership and our social credibility, we are regarded as a leader in that field in Namibia, both within the community and government, but also within the mining industry. And we do have a trusted and long-term relationship with our host community. And finally, in terms of government support, not only have we enjoyed government support for a long period of time, but we have a 5% local shareholder who is the One Economy Foundation. And that is the body that operates the altruistic and social activities of the First Lady, Monica Geinkos. So we've got a very close relationship with government. And I should add that Ms. Geinkos was a board member of our company for many years before she stepped into public life. Now, in terms of permitting and tenure, we have the ideal form of permitting to see out a bear market so that we're ready for action as our project is ready to finance and deliver. And that's called a mineral deposit retention license. And beyond that, as I say, we have environmental clearance in place for our mine. We have environmental clearance in place for the linear infrastructure and strong community, political and government support as well. Now, what does that all add up to? Well, what it adds up to is a company and a project and an asset and a team that really are in a position to have a globally significant impact. That project that I've been telling you about can produce 3.5 million pounds of uranium per annum. That's enough to service 7 to 8 large-scale conventional reactors, or alternatively, an investment of about $50 billion in electricity production. Looking at it another way, the if that nuclear power displaces coal, for example, then that will displace 76 million tonnes per annum of carbon dioxide, or 25 million tonnes of coal. So it really does move the needle. And at a local sense, we would employ 760 Namibians. And in an African context, that then leads to very substantial multiplier effects. So we would expect to have a positive impact on about 5,000 families as a result. So in summary, what I've wanted to share with you about our project and what we've been doing in Namibia and what we've been doing for the last 15 years is that, first of all, Etango is globally significant asset with a £3.5 million per annum production and the capacity for further expansion and scalability. The economics are robust. We've now really comprehensively de-risked those with a PFS and also with a pilot plant that we've run for several years, and low hurdles to development, particularly now that we have a attractive capital cost. Our environmental approvals are in place, very, very important for this sector, and we enjoy political and community and government support in the jurisdiction of Namibia. It's a premier mining jurisdiction, but in particular with uranium, that history of export and that community support is it really makes our job as a developer much easier. The project is low technical risk, and that is very important to our customers who want security of supply. And then finally, with the introduction of Etango 8, we have those two distinct pathways to development. And with the smaller project, we've got the opportunity to get into production sooner with lower development hurdles. And once we're profitable, we can then add the additional expansion to achieve the originally envisaged giant scale of Etango 20. I'd now like to turn to the uranium sector. And I hope talking about Bannerman has whet your appetite to understand why we're very pleased to be in this sector. And really, I'm going to focus on two things: the dynamics today and what's over the horizon. What are the key thematic drivers that have generated an enormous amount of interest in this sector and the type of momentum that I showed you on that front end slide when I shared with you the share price graph that we've had. So in terms of current dynamics, first of all, this sector is running at a deficit. So in other words, on a total annual consumption, in other words, the amount of uranium that is consumed in all of the reactors around the world, that's about 175 million pounds at the moment. After you've taken all of the uranium that's mined and all of the uranium that's produced through secondary supplies, we're running a 20 million pound deficit. So almost 15% of the current consumption is not generated from new production. So what happens? Well, the utilities around the world are drawing on their strategic inventory, and that's a situation that has a very short shelf life. That situation was exacerbated last year because of COVID disruption, particularly in Kazakhstan and Canada, but also in Namibia. The production stats that I was just telling you about were in fact 20 million pounds lower. So the drawdown of inventories around the world last year was in the order of 40 million pounds. We are also seeing that disruption extend into 2021. So Cigar Lake, the world's largest uranium mine, their 2021 production will be about 6 million pounds less than forecast because of COVID. And we've just seen some warnings now out of Kazatomprom, the Kazakh giant, that they will need to be careful about their year-end production because of COVID restrictions that are taking place in Kazakhstan. Now, against that immediate supply imbalance, we also have supply depletion that will make that picture look even more dramatic. And that's because over the next decade, 4 of the world's top 10 uranium mines run out of ore. In fact, 2 have already done that, Ranger in Australia and Cominac in Niger. They've closed down just this year. In addition to those headline mines actually coming to the end of their life, the tier one Kazakh assets, many of those are depleting and reducing their capacity to produce over the next 10 years. And as a result of that, we will have a much lower profile of current producers at a time when demand is increasing. Supply is very limited because we've been in a long bear market. There's been a dramatic underinvestment in new exploration and new production. And as a result, there's very few projects that are actually ready and advanced like ours are to come to the market when the price is ready. And as I said, it is a demand industry. It is a growth industry, particularly coming out of China, India, Russia, the Middle East. And also, as we're seeing now in more mature markets like the US and some parts of Europe, nuclear power for its decarbonisation credentials is back in favour and being well supported by government. So what does that all add up to? Now, what this graph is, this is what the World Nuclear Association publishes as part of its nuclear fuel report. This is the 2019 document. We're only a couple of months away from the 2021 revision to this. And I can tell you that I know these figures very, very well. In fact, I co-chair the working group that determines the demand projections out to 2040. It's a reference case that we're looking at, and that dark black line is the demand reference case. There's a upper case and also a lower case. And we think that the reference case is the most reliable, although it doesn't take into account the wonderful tailwinds that we're seeing in this sector that I'll talk to you about in a moment. Now, when you look at those bars there, the first blue bars are primary or mined production. So that's what is being mined around the world today and going forward. And you can see the way that that tapers off. That's the supply depletion that I was just talking about. The light blue on top of that is the secondary supply. That's supply that ranges from a concept called underfeeding to a Russian program where they're taking materials that weren't very efficiently processed back in the Cold War days and reprocessing those tails. That's what we mean by secondary supply. You can see a few bars there above that, and that is the projects that the WNA believes are likely to come on board in that time frame. And they fall into various categories, including our Etango project. And then finally, those golden bars that sit above that first line, that supply line, that is mines that are on care and maintenance. They're mines that have been turned off because it isn't economic to run those projects. And that is what a deep, decade-long bear market does to supply. So what can we see from that? Well, even after those care and maintenance assets are turned on, we will see an opening of that deficit that I described. I've adjusted those 2019 numbers to take into account the COVID disruption in 2020 and some disruption in 2021, and also Kazatomprom's extended commitment to supply discipline, which wasn't confirmed when we published this report in 2019. So when you look in that red circle, you can see that in fact, the primary production is a lot lower than was forecast by the WNA back then. That has been exacerbated by inventory drawdown, which is what the utilities have had to do to meet that deficit, plus financial buying from the likes of the Sprott Physical Uranium Trust and Yellowcake in the UK, and also junior uranium companies who've been buying material as well. They've bought collectively about £13 million this year. So the market is most definitely tightening. That gap starts to open up around 2025, and that's when we expect to be in production, and really opens up around 2028. And that's a period when we would look at expanding the production capacity at Etango. And then finally, I did talk about the upper case to give you an appreciation for just how much demand that will introduce. I've marked there the WNA upper scenario. So I'd like to just run very quickly through the key thematics that are driving this sector, and then we'll have some time for questions. So the first major dominant economic paradigm that is driving metals generally, clean energy, and this sector as well is decarbonisation. On top of that, we've got expansionary monetary policy, and finally, and in particular for uranium, geopolitical tension. So what does that actually do? How do those key economic paradigms drive sentiment in the sector? And I've narrowed it down really to 8 different factors. So the first is, as we all know, the world's largest economies have committed to becoming carbon neutral by 2050, and in China's case, 2060. That will have a profound effect on energy and electricity in particular. Secondly, the electricity demand itself, even in established developed countries, is growing because of the electrification of everything, not just transport, but just about everything as these countries struggle to achieve decarbonisation in their industry. China really drives this sector, and nuclear was very prominent in their recently released 14th five-year plan. There's a lot of talk these days, particularly in mainstream media, about SMRs, small modular reactors, and next generation nuclear. They're important. They are a new source of demand. They won't cannibalise the existing forms of nuclear. They are opening up new markets like remote communities, district heating, hydrogen production through hot electrolysis, and so forth. So they're very much complementary to the rollout of conventional large-scale reactors. They're just smaller, more flexible, and will be able to be produced less expensively in factories. So apart from just creating a new source of demand, what they're also doing is they are flexing and changing public opinion for the better about nuclear power. And if you want an example of that, just have a look at what Bill Gates and Warren Buffett have done in Wyoming. Because of expansionary monetary policy, we are entering a commodity super cycle and a flight to real assets. And that's because previously conservative investors have to pay to put money in the bank. So they're looking for different sorts of beta returns, and commodities are receiving a lot of the tailwinds from that. The next one is, for similar reasons, we are seeing in this sector the impact of generalist investors. They're coming in through ETFs, they're coming in through direct investments and speculation in the physical products, say through Sprott or through Yellowcake in the UK. I talked about geopolitical tension, and to give you a feel for that, this is a very concentrated sector. So the top 10 uranium producing countries in the world control 95% of the market. But not only that, of the top 5 producing countries in the world, only 2 of them use nuclear power. And in fact, only one of them uses nuclear power, which is Canada. And of the top 5 nuclear power producing countries in the world, the top 5 uranium consumers, only China and Russia and Canada produce uranium, and the largest, which is the US, effectively doesn't produce uranium anymore. And one of the other largest is France, which has no uranium production, and South Korea with no uranium production. So it's it's an industry and a sector which is in heavy disbalance. And because of that imbalance, the geopolitical tensions that we're experiencing everywhere have the potential to really affect and distort this sector for the benefit of investors. Finally, we're seeing a wall of money coming into ESG and green finance. Bloomberg, for example, anticipates that total ESG assets under management will reach 53 trillion by 2025. And nuclear power has finally come into the spotlight for its very strong ESG and green credentials. So if we look at how these 3 megatrends or these core economic paradigms are driving this sector, you can see that decarbonisation, expansionary monetary policy, and geopolitical tension very directly drive the uranium and the nuclear sector. And you can also see where a number of these very important thematics are appearing on the boundaries. And of course, right in the middle of all of that is the decarbonisation imperative. So that's really what I wanted to share with you. It's a very exciting industry and it's an exciting investor opportunity. And I'm hoping that there might be a couple of questions that I can answer.
Yes, there are quite a few questions, Brandon. So we have about 10 minutes, lots of questions from our viewers. Let's jump right in. So will water, electric, rail, ESIAs be completed as part of the DFS? And if they are to be done as a separate effort, what's that timeline like?
So first of all, with water, the water that we will access comes from NamWater, which is the parastatal, and they will get that from excess capacity in the desalination plant at the coast. They will need to do an ESIA, although that tracks two other existing pipelines that are basically in a road reserve. So that's straightforward. The baseline work and so on has already been done. So that's very straightforward. Power will need to run a power line again in parallel with an existing line up from the Quiseb substation. And the other linear infrastructure and project EIAs are already in place. So that's work that we would do in parallel with the DFS and wouldn't anticipate any delays.
Has any consideration been placed on having a sulfuric acid production plant built as part of the mine infrastructure, given how much the LOM costs are for acid and power? And is that an option to consider for the larger scale mine scenarios, or is it just not economically beneficial?
It's most definitely an option. It's one of those things that you want to do later in your study process rather than earlier because things are changing. So we will look at that as part of the DFS and we'll evaluate the benefits of an acid plant versus trucking in acid. But one of the things that we're quite advanced on is procuring local acid. And if we can succeed in doing that, then it's unlikely that establishing an acid plant will be competitive, and we would much rather use locally produced acid at a much lower cost.
Where are your largest exports, and what are your future plans for new export territories?
Well, the great thing about Namibia is it's friends with everybody. So despite all of the geopolitical tensions that we're seeing between East, West and Far East, Namibia exports uranium around the world, and it has very close bilateral relationships with the US, with China and with Russia, not to mention France, who have Eranos in Namibia itself. So we would anticipate that our customers would come from throughout the nuclear power world, and we would have utilities and state-owned operators as our customers, and a very broad market in that sense.
So why are current producers such as the Uzbeks continuing to put their production out for sale at current prices when there is continued belief of an imminent price rise? So why wouldn't they hold back their production for 6 to 9 months to see where the price can go?
Well, firstly, it's just not their model. They can make money at current spot prices, and so they do. It's not their style to want to operate a financial business, which is what they would need to do by putting those pounds as working capital and financing their own trading activities in that way. So they can make money, and so they sell it that way. The point to understand, though, is they have an impact when the spot market is fairly illiquid, as it is at the moment. So that relatively small amount of selling impacts the market because there's also only a small amount of buying. And as we see both utilities but also financial players start to put pressure on that spot market, the impact of a relatively small amount of profitable selling by the Uzbeks will diminish, and they'll enjoy higher prices like the rest of the market.
You mentioned that you had no debt, but you did a previous raise. How much did you raise, and at what valuation, and will you have to do another raise?
We raised in February. So we raised that $12 million, and we raised that at 10.5 cents. To put that in context, our VWAP for the 12 months prior to the raise was about 6 cents, and that took into account the very large volumes that we did in December and January. So for us, it was a very healthy raise. Since I've been leading the company, and I came in at the beginning of 2016, it's been a real strength of ours, our capital management. So when I came into the company, we traded at 3 cents, and it was very, very tough times back then, I can assure you. But nonetheless, we managed to raise at 3 cents in 2016, and we raised $4 million then. In 2018, we then were able to raise at 4.6 cents, so a good premium to that. Still in a very difficult market, but we took $8 million. So I felt like we did our work very well to then raise. The next raising was at 10.5 cents, and we took 12 as a result. So what that cash balance does is it means that we can complete the DFS at Etango 8. We expect that'll cost about 4 million Australian dollars. And it still means that we've got enough working capital to do everything else that we need to do.
And what is management's percentage ownership in the company?
About 10%.
Do you have any joint ventures, or are you looking for any partnerships with any majors? And do any other majors utilize property near you in this space?
We don't have any joint ventures, and we're not currently seeking a joint venture partner. That would only make sense as the market matures a little bit more and there's a greater level of tension around our asset. The majors are in Namibia. So CGN, the Chinese giant, operate the Husab uranium mine, which is 20 kilometres from us. CNNC, the other Chinese utility, has recently bought control of the Rossing uranium mine from Rio Tinto, and they also have a 25% in the Paladin mine, Langer Heinrich. Orano are in Namibia, although they're not operating. And all of the big utilities, both Japanese, American, European and Chinese, they've all satisfied themselves with Namibian production and customers of Namibian uranium.
Last question. So uranium is a very complex sector and you're still a small company. Talk a little bit about the expertise of your team and how you guys are making this happen.
Yeah, thanks. It's a good question, and I probably should have talked about it in the presentation. Uranium is complex. It is a different business. It's not like copper or gold. And we've been very cognizant of that. So for a start, myself, I'm quite embedded in the sector. I've been in uranium for a long time, initially as a mergers and acquisitions lawyer, doing some of the deals that you would have heard of back in the last boom, but also in Namibia, I've been in the uranium sector since 2009. And now at an operational level, the chairman of the company in Namibia is a chap called Mike Leach. So Mike Leach is the oldest statesman of the Namibian uranium industry, and I really mean that. He was the managing director of the Rossing uranium mine at a time when it was the largest uranium mine in the whole world, and he was actually the CFO there for 15 years before, so he had responsibility for all of those things to do with product sales and contracting and so on. So other than knowing the business inside out, he knows the mine that is really the closest analogue for what we will be constructing. Our managing director in country is Werner Evolt, and he was the mining manager at Rossing, and he came across to us in 2012. So again, very deep understanding of this style of mining and a very deep and long understanding of the uranium sector. And then our board complements the other things that you would expect us to have with Ronnie Beaver, who is our chairman in Australia. He used to run Rothschild in Australia. Ian Burville, who has very deep financing experience and was a partner at RCF, and Clive Jones, who's a geologist who was the original founder of the company back in 2005.
Sounds like a stellar team.
It's a great team. I really enjoy it. We've done a lot. It's a terrific team.
Thank you so much for this presentation. We love to hear this type of work, and we really look forward to your updates in a very important sector. Thank you, Brandon, so much.
Thanks so much, Emma.
All right, everyone, this is just the beginning. We've got some more great companies coming up. Remember, as we transition to the next presenter, you're going to see a black screen, but stay with us because we're coming right back.